Welcome back to the deep dive. So you asked us to peel back the layers on, well, one of the Indian market's most compelling strategic pivots right now, Anant Raj Ltd.
Yeah, it's fascinating. For 5 decades, this name has been synonymous with rock-solid real estate development.
Exactly. But today, they are making massive headlines in a whole different space, digital infrastructure.
It really is the ultimate balancing act, isn't it? You've got a company relying on its legacy strength in physical assets. We're talking prime debt-free land here to fully fund this really aggressive transformation into data centers and cloud services.
And the latest filings, I mean, their Q2 and H1 FY26 performance reports, they really seem to show just how far along this transformation is.
They absolutely do.
Okay, let's unpack this then. Our mission today is to understand how the frankly incredible performance of their core real estate business is providing the fuel,
Yeah, the capital.
the capital, and I guess the confidence needed to tackle the tech world so aggressively. We're going to cover the financials, which are looking pretty strong,
Very strong.
the ambitious megawatt roadmap, and, the foundation that makes it all possible.
Right. So when you look at the consolidated performance for the first half, H1 FY26, the story isn't just growth, it's really accelerating momentum.
Okay.
Revenue grew by 24.22% compared to the previous year's first half. It reached 1,223.2 crores.
That's a solid top-line increase, definitely.
Yeah.
But here's where I think we need to focus: the profitability metrics, because the growth in profit seems to be significantly outpacing revenue growth,
It is.
which, that's usually the sign of a company getting serious about operational efficiency.
Exactly right. For H1 FY26, look at EBITDA earnings before interest, taxes, depreciation, and amortization. It saw a huge jump.
Okay.
Grew by 43.17% to 338.58 crores. And this jump didn't happen by accident. It pushed their EBITDA margins up by 371 basis points.
Wow. And just for listeners, a basis point is 1/100%. So 371 basis points.
Okay.
That's nearly 4 full percentage points of margin expansion in just 1 year. That sounds like a massive structural shift. Strategically, what does that kind of surge tell us?
Well, it signals two main things, I think. First, that their legacy real estate operations are running incredibly efficiently, managing costs, leveraging scale.
Okay.
And second, it suggests that, any early monetization from these newer, perhaps higher margin segments or just disciplined capital deployment, it's already having an outsized effect on the bottom line. It's financial leverage in action.
Right. And that operational excellence, it flows right through the P&L, doesn't it? Profit after tax, PA.
Yep. PIT was up 34.28% year over year, hitting 264.08 crores. And similarly, their PT margins expanded too by 168 basis points. They're now standing at 21.24%.
Impressive.
And we see the same kind of accelerating trend in the immediate quarter snapshot, Q2 FY26. Revenue was strong, up 23.00% to 630.79 crores.
Okay.
But again, look at the profit figures. Q2 EBITDA jumped 43.85% to 177.94 crores, and PEAT was up 30.79%.
So profit growth is almost double the pace of revenue growth.
Exactly. That's a crucial takeaway for you, the listener.
Those numbers, they paint a picture of real fiscal strength. But they also kind of beg an important question, don't they? I mean, scaling up massive data centers is incredibly capital intensive.
Oh, absolutely.
Is this accelerating profitability enough to actually fund the hundreds of megawatts we're about to get into? Okay, here's where it gets really interesting. Anant Raj isn't just building buildings anymore. They are building digital infrastructure. And the scale of this plan is, well, genuinely stunning. They've literally gone from talking about square feet to talking about megawatts.
That's the new language. Their current operational capacity is 28 milliW IT load. Now, just for context, MW IT load measures the maximum electrical power available for the IT gear.
The servers, the storage.
Exactly, the actual servers and storage in a data center. It's the core measure of capacity.
And their intermediate target, it's not exactly modest, is it?
Not at all. They plan to hit 117 milliW IT load capacity by the end of FY28. That's across their facilities in Manesar, Rai, and Panchakula.
And what's really critical, I think, for investors to note is they've publicly stated the funding for this entire CapEx. It's already lined up.
That's right, fully funded. And, that's just the intermediate step. Their long-term vision, their roadmap, goes all the way to 307 milliW IT load capacity by 2032.
Wow.
to commit to building nearly 10 times their current capacity in less than a decade. I mean, that shows an unparalleled conviction in the future demand for data storage and processing in the region.
Yeah, you can really see that conviction in the physical steps they've already taken. They enhanced the Manasar facility to 21 miller WIT load. They operationalized the second facility in Panchkula at 7 mil WIT load. But they even held a big event, didn't they? For it built Soil to Server back in August 2025.
They did, showcasing their capacity, tying that real estate legacy directly to this new digital service. It was a smart move.
Smart. And smart strategy, too, building in redundancy.
Absolutely crucial. The Manasar and Panchkula facilities, they're designed structurally to act as data center and disaster recovery sites for each other. That adds significant value and, reliability for high-end clients.
But they're pushing beyond just, basic co-location, right?
Yeah.
Renting out rack space.
Oh, yeah, much further. They're aggressively moving up the value chain into higher margin cloud services. They've got a brand for it. A shock cloud.
A shock cloud.
Infrastructure as a service, or ATIS, is already in advanced stages for deployment.
Okay. And future plans?
Future targets include platform as a service, PTEA, and software as a service, SaaS. They plan to offer these in partnership with Orange Business.
Interesting partnership.
It is. And this move is strategic because PAS and SaaS, they shift them away from competing just on physical space and power towards competing on integrated, more profitable solutions.
Which brings us to maybe the most crucial detail here, their internal commitment. They've actually stated that 25% of that huge 307 milliWIT load capacity will be utilized specifically for their own cloud services.
Right. So a quarter of their future infrastructure is dedicated straight to the highest margin part of their new business line. That's a serious commitment.
It is. And you mentioned funding earlier. None of this ambitious CapEx happens without serious institutional confidence, right?
Absolutely not. And this brings us back to that funding being lined up. They executed a highly successful QIP, a qualified institutions placement.
Which, just for clarity, that's essentially selling shares directly to big institutional buyers, right? Banks, funds.
Precisely. And institutional confidence was so strong that subsequent to the quarter end, actually in October 2025, they completed that QIP, raised nearly all 1,100 crores. Specifically, a 1,099.99 crores.
Wow, almost exactly 1,100 crores.
Just about. And that capital injection is a direct result of institutional investors, both foreign and domestic, buying into this data center pivot. It provides the crucial non-debt funding needed to build out this fast-growing, capital-intensive segment without having to rely solely on, say, internal real estate cash flow.
Yeah, and to really understand the security and, frankly, the execution capability needed for that massive pivot, you have to appreciate the bedrock.
The foundation.
Their real estate foundation. This is where that 5-decade legacy truly gives them a strategic edge.
And their core principles, they state them clearly. Location, permission, and execution. It's all supported by an incredible kind of non-replicable asset.
Approximately 320 acres of prime land in the Delhi NCR region.
Prime land.
And critically, as you mentioned earlier, that land is debt-free. That is the ultimate balance sheet strength. It's like a capital reserve just sitting there.
Absolutely. And the residential arm, it's not like it's slowing down to make way for data centers. It's actively monetizing this land bank. Very actively. In Gurugram, Sector 63A, they're in the advanced stages of launching the Estate 1. This is a luxury high-rise development.
Big project.
Over 5 acres, potential for over 1 million square feet of space.
Okay.
They're also expanding established communities. Phase 4 of the Anant Raj Estate commenced another 6 acres, about 500,000 square feet potential there.
Right. And they have JVs too.
Yes. Their 50.50 joint venture, Project Navia, with Burla Estates, is set to start Phase 2 delivery from December 2025 onwards. So it shows continuous, reliable project execution. That's key.
It builds confidence.
Definitely. And we also see a robust pipeline of future launches. There's Group Housing 3, over 5 acres, expected to get launch permissions in Q4 FY26.
Right.
This kind of activity ensures a continuous generation of fresh cash flow.
Buffering the capital needs the data center side.
Precisely.
And then there's the annuity business, the rental income stream. That must provide incredible underlying stability.
It does. Their commercial portfolio is about 1.92 million square feet of leasable area. And importantly, that space is fully leased under long-term agreements.
Predictable income.
Very predictable. Vital for their overall balance sheet health.
And they're looking to unlock more value there too, aren't they? Something about FSI increases.
Yeah, floor space index. It basically dictates how much you can build on a piece of land. If FSI increases, they can potentially build up on existing properties like the Ashok Tower Hotel and Anant Raj Center too.
So more rental yield without buying new land.
Exactly, maximizing what they already have. And they project pretty substantial results from this. Potentially an additional 55 crores annual rental from the hotel property and 75 crores from Center 2.
So the legacy assets aren't just sitting there. They're being actively optimized to generate more cash.
That's the strategy, proactive optimization.
Okay, so when we pull all this together, the financials and the strategy, the story really is one of fiscal discipline enabling hypergrowth. It feels like their balance sheet was deliberately prepared for this moment.
I think that's fair to say. That preparation is best illustrated by their net cash positive status. They achieved that after prepaying 125 crores of debt.
Net cash positive, that's huge.
It is. And if you look historically, their net debt just plummeted. It went from nearly 1,500 crores back in FY21
Wow.
down to a remarkable 50 crores by FY25. This aggressive deleveraging basically cleared the runway entirely for the QIP and this whole digital expansion.
Right. This financial health, it allows them to operate effectively on two fronts at the same time. On the residential side, you've got this massive 11.41 million square feet of ongoing and planned projects. But they're also being smart about land strategy, exploring things like joint development agreements, JDAs.
Yeah, for asset-light growth.
Explain that a bit.
Well, instead of always funding the development of their, say, 83-odd acres of fully paid freehold land themselves, JDAs let them partner with others.
So they share the cost and risk.
Exactly. Mitigates risk, accelerates monetization, and crucially, preserves capital for the data center business, which needs a lot of it. It's a key strategic move.
Makes sense.
So, if we connect this to the bigger picture, the entire forward-looking strategy is really a masterful act of strategic balance, you could say.
Okay.
Their immediate goal in the data center segment, bring an incremental 35 milliBUW IT load online that's at Manasar and Rai in the next financial year, and roll out those cloud services we talked about.
So you've got the reliable, consistent cash flow coming in from the fully leased annuity business.
Yep. Rock solid.
And the
There.
And that stability provides the foundation and, importantly, the capital structure for this aggressive, maybe higher risk, but potentially high reward digital infrastructure play.
That's it, exactly. They're using their proven skills in physical execution. Building complex structures on time, on budget, and applying that same discipline to a tech-driven asset class. It's the core idea, the core thesis of this whole transformation. #tag outro.
So what does this all mean? I think this deep dive really reveals a real estate company that's, well, leveraging its 5-decade legacy, its debt-free land bank, its execution capacity,
which is unparalleled,
to fund this massive strategic shift into the digital age. They are fundamentally reshaping their identity. It's quite something to watch.
And the accelerating margins, the robust financial health we saw in the Q2 and H1 results, they really validate the initial success of this strategy. It's driven by both strong real estate performance and that capital injection from confident institutional investors.
Absolutely. Which leads us to the final thought for you to maybe mull over. Given this really ambitious target of scaling to 307 milliBUW IT load by 2032 and dedicating a full quarter of that capacity to higher margin cloud services, PAOs and SaaS, what does it truly take for a traditional real estate company to successfully transform its identity, to become a tech infrastructure provider while still maintaining its decades-long reputation for, brilliant physical asset execution?
Yeah, that tension between the soil and the server.
Exactly. That tension is really the core question here, isn't it? Something to think about.